Hey everyone, this is Kirk here again at Option Alpha. So today we've got a huge guide for you on technical analysis for beginners. So if you're brand new to trading, brand new to technical analysis, this is the guide for you. You'll want to go through this one. Of course, if you have any questions or comments, let me know in the comment section below. So look, technical analysis, as you probably expect because you've found this video, is still one of the most popular tools for traders because of its seemingly easy and visual nature. But of course, the big $1 million question is, does using technical analysis mean you can predict the future of the markets? And the answer to this question is 100%. You can definitely, I'm just kidding. No, you cannot predict the future of the markets with technical analysis. So I want to make sure we get that out of the way. It's a huge, valuable tool, but of course, it's not 100% predictive. You need to know how to use it, how to set them up, how to incorporate technical analysis into your trading, which is what I hope I can do for you in this video. So look, to me personally, technical analysis is a great tool. I use technical analysis. I think it's a great tool for traders because what I think it gives you is it gives you signals based on real market data. And I think you can use those to tilt or lean into or out of trades. That's how I really think about technical analysis. To me, it's not an all in, all out scenario. It's more of a leaning and tilting into or out of different trades. And so what I mean by this is that if you're thinking about like driving down the road, so if you're driving your car and the cars in front of you, you can see all the cars in front of you have their brakes on and they're starting to slow down. And you got all these lights ahead of you, these red lights. Well, does that mean that you're probably going to hit the gas, right? No, you're not going to hit the gas, right? That'd be stupid. Does it probably mean that you're going to slam on the brakes and stop the car abruptly? Probably not either, right? You're driving down the road really fast, like that could cause an accident. So you're probably going to tap the brakes, right? You're going to start to slowly tap the brakes. And that's exactly how I think about technical analysis is like literally like driving down the road. So if you're stopped and now everyone starts moving, you see those brake lights start to turn off. Now traffic is starting to move. You're not going to hit the brakes and sit there, right? You're not going to do that. You want to start going. And likewise, you're not going to slam on the gas and, ram the people ahead of you. No, you're going to slowly hit the gas and slowly start moving forward. So you want to think about technical analysis and signals as this idea of like tapping the brakes or starting to hit the gas a little bit, but not doing the extreme of either of these. So it's also important to note and explain that technical analysis to me is not classical chart reading. So in the most classical sense of like pattern reading or chart reading, that's not what we're talking about. To me, in my opinion, a lot of chart or pattern reading is truly subjective in nature. And personally, I'm not good at it. I've tried it for many years. I feel like I've seen patterns, right? Like, that like gif of like the kid who sees dead people. Like I see patterns, but I don't really see them and I'm not really good at it. I know that there are people who are good at it. I'm not downplaying it. There are totally traders who have made livings on trading chart patterns. They're really good at it. I'm just not one of those people. So I can't tell you exactly what this pattern is and what that pattern is because I think a lot of it is subjective. It also requires you to watch the markets, and that means you're prone to making erred decisions. So you're human, you have a bias. You might see things that are different than might actually be there. It doesn't mean that they're not there, but it just is very subjective and error prone. So for example, I'm not talking about things like support and resistance. I know that support and resistance is there. People talk about it. They look at it. It does require you to look at the charts all the time. And then you have to make this subjective decision of where support and resistance are. So you can also look at chart patterns. Like these are very popular. Again, we've got education on different ones and what they generally are and how people generally use them. But it's really hard to, I think, use them in trading because what a cup and handle pattern is pretty subjective. Like I don't know how to kind of look at a chart pattern and say, this is the exact cup, this is the handle, this is the breakout. Again, people are really good at this. I'm just not one of them, and I don't use that for my trading. The reason I don't use it is because, like I said, it's very subjective in nature. So here's an example. It's just a chart, random chart pattern, right? But I could draw these current support lines, right? So I could say, okay, here's a support line and here's a support line and now it's resistance and whatever the case is, and I could draw these. And these might be all totally accurate and true. Somebody else might say, yes, that's definitely it. But I could equally draw different support and resistance lines. Maybe I tilt them a little bit and I say, well, actually the real lines are kind of more here and here. And these are the more, accurate support and resistance lines. Is one better or worse than the other? No, they could probably both be true, maybe both be useful. But it requires, again, that you actually look at it and you know what they are and you have to analyze them. So I think it's really hard to do, which is why I kind of lean towards technicals more. And then, of course, you get the people, and I literally have been sent charts like this before where they're like, hey, these are my support and resistance lines. And they literally look like somebody threw down a bunch of crayons and lines, and you have no idea. And these all could be true. I don't know, but people have sent these charts. I'm sure they're out there online. You see these ones where it's just crazy technical or like chart patterns all over the place in lines. I don't know what they mean, so I don't use them, okay? So in general, I'm more generally of a numbers guy. I prefer technical analysis because, like I said, it uses hard data to give me more clear buy and sell signals, which again, doesn't mean I'm going all in, all out of securities. It means that I'm kind of leaning into or tilting into positions in or out. So first, let's answer the question. I know we got through a lot here, but let's answer a question like, what is technical analysis broadly? It's broadly the study of past market action to try and predict possible future moves. Now, we know we can't do this 100%, but again, it's trying to get an idea of, is the market a little bit overbought? Is it a little bit oversold? It tries to use historical data, mostly price and volume, and that guides decisions on entries and exits, which makes you and me as traders try to be as objective as possible. Now, the focus is, of course, on data-driven signals. So instead of emotions, instead of subjectively looking at lines on charts and saying this is support, this is resistance, what you're doing with technical analysis is you're using data. You're using, math formulas, momentum, trend, right? Calculations that say this is the signal. This is where the market is. And so that if you use it properly, and that's really the key to doing technical analysis, I think it can give you an edge in the market. It can give you that indicator, that lead-in signal to say, hey, things are getting too hot, things are a little too cold, they're a little too bearish, a little too bullish, here's an opportunity. That's what you want to use it for. So my goal in this guide is to, of course, break down technical analysis. I'm going to cover some key indicators like simple moving averages, RSI, MACD, and then I'm going to show you how you can even automate some of these strategies with some examples. So first, we have to describe technical versus fundamental real quick. You'll probably see that there's a lot of traders who use fundamental analysis. And so I just want to make this quick distinction, which is that there's two main approaches to analysis. You could say technical and then fundamental in this example. Unlike fundamental analysis, which is really more of the company health and news, right? Technical analysis is going to ignore that and focus on the actual behavior of the market. So that doesn't mean that fundamental analysis isn't important, isn't valuable. It's just that if you're going to use technical analysis, you have to understand that it's pretty much ignoring all of that. So you're not going to see RSI somehow incorporate earnings into the RSI reading. It doesn't matter. So technical analysis is going to ignore all of that stuff and really focus on what is actually happening with the security. How is it trading? What is the actual price action? What are people doing with their actual money, right? So essentially, fundamental analysis looks at somewhat of the intrinsic value of a security or a market or an ETF, earnings, revenue, economic factors, things like that, whereas technical analysis relies mostly on the price action and statistics derived from the actual trading activity. Now, many traders do blend both approaches. I'm not saying that you have to use technical analysis and totally forget about fundamental. It's up to you how you want to do it. But they do blend it and they do start to incorporate some technicals into their trading. Usually fundamental analysis is more what to buy, like what things to get into, what things do you want to look at, and then you start to incorporate technical analysis into that. Now, me personally, because I don't trade super long term where fundamental analysis is going to play out over quarters or years, most of my trades are much shorter in duration and timeline. So it really doesn't matter for the fundamentals to me. I don't look at them. I don't check them. I often trade mostly ETFs anyway. So mostly I'm going to be using technicals in combination with other things that I do to influence the decisions that I make. So let's look at some examples. And of course, I'll show you how to automate these signals once we're done here. But I just want to again show you some different examples of some of the more popular technical indicators. So the first one that we're going to look at, this is the easiest one to understand if you're new to trading, is moving averages. There's generally two types. There's simple and exponential moving averages, just a small difference in the calculation, but generally speaking, moving averages are popular because, like I said, they're very simple to use. They give very clear, easy to understand buy and sell signals. And what it does is exactly what the name suggests. So it takes the average price of a particular security, asset, stock, ETF, whatever it is. And it gives equal rate to each day's price and just plots a line of the average price over time. So for example, if you had a 50-day simple moving average, SMA, then what it would do is it would add up the last 50 days of price action and divide that total by 50 to get an average price over the last 50 days. And then it plots it on the chart. The next day, it drops the first day of those 50 days and adds the next reoccurring day. And it just continues to plot that line over time. It incorporates new prices coming in and then the other prices dropping out. Now, it's important to remember that moving averages don't necessarily predict market direction in and of themselves. It's just a metric. It's just showing you where the market is and maybe historically where it's been, where the average price has moved. But it kind of defines current direction and trend, and a lot of investment vehicles or ETFs or even hedge funds use moving averages as sort of like a trend indicator. So you would have something like this. This would be like a very simple example. Again, we'll give you guys all sorts of links and resources right below this video. But you'd have the price here, which is in green, and then you'd have the 50-day moving average. So that darker blue line here is going to be your 50-day moving average. And so all it's doing, like I said, is it's taking a chunk of days. It's say like this is the 50 days, right? And then it's plotting the actual average. And so as that chunk of 50 days starts to move, right, then the average price would continue to go down or up or whatever the case is. So you can start to see that the 50-day average, moving average here, kind of follows the market a little bit more, right? It kind of ebbs and flows with the actual price action of the stock because it's more responsive. It's using shorter periods of time. It's not averaging many prices over time. So 50-day generally and 30 and 20 are going to be more reactionary to the actual price of the security. If you look at the 200-day moving average in this case, you can see that it's taking obviously 200 days of trading data and then plotting the line. So it is going to move a little bit, but it's going to be a little bit less reactionary. A lot of people use the 200-day as kind of a long, broad term trend indicator where they look at it and they say, look, if the price of the security is below the 200-day moving average, that would designate a downtrend or a bearish signal. If the price starts to move above its 200-day moving average, that would be more of like a bullish uptrending signal where you would maybe want to get into the security or start getting long the security, right? And you can do the same thing with the 50-day moving average, so you can do that as well. Here's an example right now, at least at the time that I'm recording this video. This is a look at the QQQ. We're going to use this for all of the examples today because it's got just really good learning signals and it's doing a lot of movement right now. So I don't know where this is going to go in the future, but hey, maybe some of these technical indicators might predict a little bit of where they go. But here's the QQQ as of right now. And if you look at this one, this is incorporating the 50-day moving average into the actual chart of the Qs. And this is that blue line that you see right here. Now, like I said, the 50-day moving average is going to smooth out the price action to a certain degree, but what it's going to do is it's also going to be a little bit more reactionary. Now, what sometimes people will do with moving averages is they will use the signal of the stock itself crossing above or below one of the moving averages. So for example, down here, this might be a bullish buy signal for QQQ at that time, right? Because the stock crossed above its 50-day moving average. And you can see actually, if you kind of like really look at it really close, you can see that if you did actually go in and go long the QQQ, you had a nice good run here and it started to obviously make a pretty good move. You can also look at it with a sell signal. So where the stock crosses below the 200 or the 50-day moving average, that would be like right here on the chart. You can see it would cross below. That might be your sell signal. So now if you have a position in QQQ or you want to go bearish in QQQ, that would be your sell signal right there. And you can see that broadly speaking, the market did continue to move down as after that signal. So it's not a perfect one, of course. It doesn't always catch things, right? Here's an example where it didn't catch this one. This would be potentially a buy signal right here. And then you could see the market actually did turn over. So as always, there's no foolproof signal. Everything is a little bit subjective, but it does broadly capture most of the trend that you see in QQQ. Now, if we introduce a 200-day moving average, just like we did in the example before, you can see this 200-day moving average is a lot more smoothed out for the QQQ, and it obviously gives you less signals, but maybe more long-term signals, which is sometimes where people like to use them. And they also like to use them as broad trend signals, like I said, for the 200-day moving average. So for example, you can see that the stock closed down below its 200-day moving average back here in the beginning of 2022. And after that, it did broadly enter a period, basically about a year, of downward action. It wasn't that it was straight down for that entire year, but if you look at the action of the Qs from 2022 to 2023, it was broadly lower through that time period, and it traded and stayed below its 200-day moving average the entire time. Now, it wasn't until you got to early 2023 did the Qs actually close above its 200-day moving average. And again, what you can see here is that we've broadly been in an uptrend that entire time. So as far as the signal goes for the Qs, the 200-day moving average has been a pretty good signal for broad trend. It means that not necessarily the markets are going to go up straight, obviously, because we've had some zigzagging in here, right? That's what's going to happen, but the broad trend has been higher. Now, what's interesting about it right now is that just recently the Qs closed back down below its 200-day moving average, which might be that we're now entering a new shift in trend where the momentum and the trend might start to be a little bit more bearish. It's not that it might go down straight, maybe it does, but we might start to see more downward trending action. The other thing that you can do with technical analysis, and a very popular thing that you can do, a lot of traders also do this in Option Alpha for signals, is you can look at the signals of the crosses of the technical analysis indicators. So in this case, you'd be looking at the 50-day moving average crossing under the 200-day moving average. That might be a nice sell signal for you right there, where you just use the technical indicators themselves to give you a signal that your bots can then incorporate into buying or selling or going long or short different securities. And then, of course, your buy signal would be the opposite. That would be where the 50-day moving average crosses above the 200-day moving average. That would be your signal right there, and that would be, again, a buy signal or a go long signal. Again, you can incorporate these into your bots inside of Option Alpha, which means that you can automate this entire process. We don't quite have that yet, but it probably might happen where we start to get the 50-day moving average start to come close and maybe give us that crossing signal, which is a bearish indicator. All right, let's move on to the next one. The next one is the moving average convergence divergence, or lovingly referred to as MACD. This is a really popular one. I like MACD a lot. I'm partial to it. I think it's a good one. MACD basically does a couple things. It builds on top of this moving average discussion that we just went through, which combines trend and momentum by basically measuring different periods of moving averages. Now, it does take exponential moving averages, which I think is a little bit better than just the simple. It's a little bit more responsive. And it takes, for example, like the 12-period moving average against the 26-period moving average, and then it plots them as a line. And then it also, I know there's a lot in it, but don't worry, it's just a bunch of moving averages at the same time. And then it also plots a 9-period exponential moving average of the combined MACD line that you see there. The whole goal with MACD is to see if the market is generally getting into momentum shifts. And this is how we see these with convergences and divergences against shorter versus longer periods. Are short periods of time starting to diverge from longer periods of average prices and vice versa? And that's what you basically get, is MACD basically shows those kind of convergences and divergences in trending markets. Now, the problem sometimes you might find with MACD is it might generate some false signals in kind of choppy or sideways markets. So it does work a little bit better with trending markets, which means maybe you could incorporate them also with some of your technical indicators, like your moving averages or your uptrend indicators. That would then give you a better signal. So here's what you generally get with MACD here. There's a couple different ways to use MACD, but you basically have your signal line or your MACD line here. That's going to be that confluence of those different moving averages. And what that's going to show you is that's going to show you if the market generally has some good momentum or some bad momentum as it starts to move. And it will generally follow the market because, again, it's a combination of moving averages kind of following the market. And what you're looking for is broadly speaking, the cross of the MACD line above its signal line, or usually it's kind of smoothed line is sometimes what it's referred to. So in this case, it would be the cross of the MACD above the signal line, which would be down here. That would be more of your bullish signal right there, or your buy signal. And then if you get the cross below the signal line here, so below the signal line would be the dotted line. This might be your sell signal right here. And this is what generally would happen with MACD. Now, the problem again, or that we highlighted, is that sometimes you do get these kind of false signals, or it creates a bunch of signals in sideways or choppy markets where it stays higher for longer. Again, that's just part of the construction of it. It's not perfect, just like every signal is not perfect, but you do get some really good ones, especially if MACD is really, really oversold and extreme. So to go back to our QQQ chart of the NASDAQ, you can see this is what it looks like today, going back historically, a couple years now. And what you see with MACD is, again, you see the MACD line here is in blue. That's the blue line. That's the MACD line. And then your signal line is going to be the one in orange. It's always the one that's a little bit more smoothed out. Because if you smooth out that MACD line for the signal line, that's how you can kind of get those crossovers, which is what you would use for your signals. Now, in this case, you would look for, and this would be a great example of it right here, where the market was really, really high, and you were waiting for that MACD signal to cross below the signal line. So in this case, you can see here, you just kind of look at this one right there. The blue line crosses underneath of the orange line. That's the signal line. That would be your sell signal or your bearish signal. That was a pretty good signal. So if you got bearish at this point in QQQ, you had a pretty good run lower, and really you didn't have another kind of classic buy signal until much, much lower. So you can see, again, if you just broadly look at this chart here, if you look at the times where MACD crosses above the signal line, so these would be bullish signals or like buy signals, these are pretty good. They're not perfect, of course. They miss some stuff, but broadly speaking, these are all bullish signals, and those all generally correlate with little moves up in the market. So we see these moves up in the market where we get these bullish signals. Again, it works better when these signals are down below this zero line. So you'd be looking for kind of bullish signals down in this territory. You don't really want to trade a bullish signal up here. That doesn't really work. But again, you can see these ones where you get these nice bullish signals here. And that means that the market's kind of ready to rebound, or maybe getting really stretched to the downside. It's got really aggressive bearish momentum, and that maybe just be getting overstretched, so oversold or something like that, you might call it. So right now with the market where it is, it's kind of interesting where MACD is super, super stretched to the downside, but we don't quite have that kind of reversal signal yet. You can actually physically see this here where the MACD line is down here around 12, the signal line is around 8. We would need that MACD line to cross back above that signal line to really get kind of that bullish signal. And the key with this is that we haven't really had that bullish signal the entire time. So if you really use MACD for your trading, that means that you're looking at this chart, you're seeing the market go down, but you're looking at MACD saying, look, this could continue to go down as we move, right? So that's a really important one. The other one, if we just kind of zoom in on some time periods here, this might give you a better idea here of these signal crosses. But here you can see this would be like a bullish signal right here where it crosses above, happens below the zero barrier, so that's good. Again, really good signal that it started to generate. The closer these signals happen to the zero line, the little bit more dicey they become a little bit more choppy. But you can see here that the signals for the bearish side or some bearish trades or downward trending trades, those are pretty good too, where you get the crossover here. A little bit of choppiness heading into this, but otherwise you do get to see these signals start to play out where it kind of told you at this point, hey, look, you probably should be starting to exit positions. You're getting this negative or bearish crossover in the MACD line against the signal. And after that, the market had a big down move. You actually saw this just recently in the broad markets in the Qs, where you got the market starting to move down. You got the bearish signal on MACD. And if you got out of positions or started to exit positions, you probably were in a good position. The other thing that you can do with MACD, which is a little bit subjective in nature, is you can look at it for divergences. So this would be not only just the divergences through the MACD indicator, but you can look at it where the MACD itself is making lower lows, right? And this would be an example here where the indicator was progressively making lower lows with a downward signal, and the market is not really making higher highs or making about the same highs. This might be a good example right here of a divergence where the market is about the same, but the underlying technical indicator shows it's kind of losing momentum. You almost saw this here too with the market here making higher highs, but MACD was about the same. That would be about the same type of divergence that you would look at where you'd say, look, I know the market's making higher highs. However, the MACD is showing that the momentum is actually kind of shifting and it's not really as aggressive as it was before. It's not increasing in momentum. So again, these would be clues. These would be signals to say, not go all in, go all out, but hey, maybe things are getting stretched. If I've got profits on trades that are bullish trades, I might want to start taking those profits. Maybe I start dabbling into some bearish positions. Maybe I start hedging some of my positions that I have. That's how you want to use these. It's not all in, all out. If you have this one here, like right now, recently, and just like let's walk through this environment right now. This environment is clearly overstretched, right? In the NASDAQ, there might be a little bit more room to go. We haven't had the actual buy signal here. We haven't had a bullish signal. But if you've got bearish trades, it would absolutely be the time to start closing those positions, right? This would be the time when it's really, really overstretched to start saying, hey, do I have some pretty healthy profits? Can I take some trades off? If you were bearish heading into this, great opportunity here. If you are long some positions, like you recently got long some positions, you never had looked at these technical analysis indicators, you might be thinking to yourself, oh my gosh, what's happening? I'm recently long in some positions, like in the last couple of days. But if MACD is super, super overstretched like this, it might be coming to an end or maybe slowly starting to roll over, right? It's not that it's going to end and reverse completely because it doesn't always happen that way. But you know that you're kind of long in the tooth. The market is really overstretched to the downside. It's kind of favoring some sort of reversal sometime soon. So maybe you start to look at that, right? So that's how I would kind of use this. If you don't have any positions at all, maybe you start to wait for some better signals. You wait a couple days. Maybe if we get that actual buy signal, you start going into some bullish positions. Again, you don't just dump all of your portfolio 100% bullish, 100% long the market, but you start dabbling into positions, right? You start layering into positions where you start getting into positions where you have something like this that's saying, hey, look, the market's overstretched and now maybe starting to reverse. Okay, let's look at another one. So another one here is the relative strength index. This is RSI. Again, another favorite one of mine. I use RSI and MACD. I like them both. RSI is more of a momentum oscillator. It moves broadly between 0 and 100. That's kind of range bound, just the way that it's constructed. And it essentially measures how quickly prices are moving up or down. And you can kind of gauge this with readings of above 70 being overbought, meaning that prices are moving too hot too fast, and oversold being below 30, meaning prices are too low, too fast, too aggressively being sold. Now, the thing with RSI, and I think a lot of people miss this, is that just like with MACD and some of these other ones too, is that it doesn't mean that as soon as a stock hits an RSI reading of 70, that magically it's going to turn around. No, it just means that the momentum is too high and the momentum might start to roll over or stop. So the analogy or the thing I always tell people is it doesn't mean it's going to stop moving higher. It just means the pace at which it's moving higher is going to slow. It's going to start moving sideways, or in the best scenario, it starts to turn over and go the other way. But any of those can happen. It's not that it's just going to turn around. So again, a stock is typically considered overbought when it's above 70, oversold below 30. Again, you can use divergences, which can hint at, kind of some weakening momentum and potential reversals, okay? So if you look at it broadly, this is what you'd see if you bring up a relative strength index or RSI technical indicator. You get these readings above 70. These would all be overbought readings. Again, it doesn't mean that the market is going to stop moving higher. It just means the pace at which it's moving higher is too fast. It means it's going to start to slow down or turn over or start to move sideways. Likewise, if you look at it on the 30 reading, it means that things have gotten really, really oversold very, very fast. And so it means that it might be coming to an end, or at least the pace at which it's moving down, it might start to decelerate, not move down as quickly. If you look at, again, QQQ, going back historically, you can see this is RSI. Here is our 70 barrier right here. Here's our 30 barrier. So basically any RSI readings down in this range here, these are going to be the ones that are going to give you kind of these bullish signals. Now, QQQ didn't have many times in the last couple of years where RSI was down below 30. When it did, most of them were good signals, at least in the short term, where they signaled some short-term reversals in the market. This is not going to be your trend indicator. It's not showing you a long-term trend. It's just more of a, hey, what's going on in the last, price action? Like, is price action going a little bit too aggressive in one direction or the other? And you can see, broadly speaking, these were good opportunities to get into the market. They're not perfect, but they're pretty good opportunities. You also see on the top side where you have these readings above 70, things are super, super hot, maybe too hot. And that means that it's going to start to at least decelerate in pace or start to turn over. And these are, I think, a little bit tougher with RSI. I think you have to take these ones with a little bit more grain of salt, only because, again, it doesn't mean that it's going to make this V-shaped reversal. So if you look at this one here, it gave us a really, really high RSI reading right about here. It definitely did not go down, right? If anything, it started to just trade sideways. So had a lot of momentum heading into it, then it started to trade sideways. Here, it traded a little down to sideways. In some of these ones here, the momentum was really, really strong. Then you got these high RSI readings, and notice that the momentum starts to shift and turn sideways, but it actually did continue to move a little bit higher. And this is sometimes the tricky part with RSI, or just something you have to understand, again, is that it's not telling you that it's going to have this V-shape top and then go down the other direction. That's what everyone assumes. It's totally wrong. RSI is just showing that the momentum should be stalling. It's getting too hot, too aggressive, and it should be starting to roll over. And so again, you can see that kind of rollover happen. Here you had about the same thing where we're starting to roll over in some of these cases, right? The momentum was really hot out of the gate, and then the momentum started to wane and roll over. You got a nice rollover into an RSI buy signal. Here, the same thing happened. It was really, really hot, took a little bit of time, but then actually did roll over. Recently, we've had the same thing where RSI was a little bit high, was a little bit hot, right? And then the market started to trade more sideways. Not necessarily huge rollover yet, but it started to trade more sideways from that signal. Now, the current reading on RSI for the markets right now, let's just go to this chart here so you can get a little bit more zoomed in look at it. The current look on the Qs, at least right now when I'm doing this video, is you do have or have had recently an RSI buy signal. Some people will do this a little bit different. They'll do it right when RSI is below 30. Some people want it to cross back above 30. That's a little bit of a nuanced decision-making process. But generally speaking, if you look at RSI right now, it looks like the markets are a little bit overdone, which means that we might get a little bit of a bounce here, or at least it might not continue down at the same pace. That might be what the indicators are showing here. So again, if you've got bearish positions, definitely start exiting those. If you've got no positions, you can start dabbling into some bullish positions in the market. Give yourself room for margin for error. Don't go all in on these, of course, but it's a good opportunity to start kind of tilting a little bit more bullish with new positions. Now, again, just like MACD, you will see some divergences in RSI. This is, again, a good indicator of, kind of looking at these ones you do have to kind of see manually if you're looking at it, but you would see about the same divergence here that you saw with MACD, where the market was actually making higher highs. RSI was actually going lower. That kind of preceded the actual move down. We saw this just recently too, where RSI was making significantly lower lows and the market was making about the same highs. So it was losing momentum even as it was kind of trying to retest and regain those new all-time highs. So that kind of preceded the move lower. Okay, so now let's explore some guidelines on how you might use technical analysis for trading. So hopefully that was helpful, just kind of going through those. There's tons of technical analysis indicators out there. These are not the only ones. These are just some of the ones I thought were helpful for beginners to get started because they kind of build on top of each other with the moving averages. But I want to give you some guidelines on using these. So best practices, in my opinion, on incorporating technical analysis in your trading, and then we'll go through some examples, how you can incorporate them into bots, how you can start to automate it. I think one of the things you can do is Obviously, relying on a single indicator can be super risky. So you don't want to rely on one indicator. No indicator is infallible. Use multiple indicators, but not too many. That's the thing I always see people do and mess up wrong is they use 25 indicators. That's way too much. Maybe even 5 might be too much. 3 maybe is a good number, right? Like 3 indicators that you do a good job with, that you understand, that kind of play off of one another, that might be really good. 3 to 4 indicators, right? Doesn't mean you can't check the other ones later, but too much is it's just too much. It's just analysis paralysis. You're just going to kill it by just analyzing too much, right? Then try layering these indicators. And what I mean by that is using them at the same time, possibly even checking them at the same time inside of your bots. And what you're doing is you're seeking consensus, because when multiple indicators say the same thing, the signal might be a little bit stronger. Now, again, that doesn't mean that you are going to go all in on that position just because you got 3 indicators to line up. You still are going to hit the brakes a little bit, hit the gas a little bit, lean into and tilt into positions. Please do not go all in just because you got 3 really good buy signals. That doesn't mean anything. It just means that there's more consensus. You can start to maybe add positions, right? But you still want to slowly get into those positions. Finally, don't blindly take every RSI or MACD signal. This again is a really big one. I'll use RSI, MACD, whatever technical indicator you want to fill in here. Technical analysis, to me, must fit into your overall strategy. And it absolutely doesn't mean you can avoid or skip other critical aspects of trading. So for example, here at Option Alpha, and what I do with my trading, positive expected values are paramount. I will not get into a trade that doesn't have a positive expected value. We calculate it right inside of Option Alpha, so you need to have it inside of your platform. And if you don't have a positive expected value, that doesn't mean that I can just forego positive expected values because the technical analysis indicator said buy or sell. Also, high probability. I want to do high probability trades with a positive expected value. If I can also do those with a lean or tilt because of the technical analysis, I will do that. So technical analysis is not a free pass to ignore all the other important rules and aspects of trading. Again, small position sizes, portfolio balance, right? Making sure you're getting in positive expected value trades. You have to do those. You can use technical analysis as an add-on tool for that. It can enhance your trading, but it doesn't need to be the only thing. So for example here, if I was using a combination of MACD and RSI, this is how I might look at a chart if I was using a chart to just trade. I trade only with bots, but if I look at a chart and do this, this is what I would look at. I would look at a combination of these 2 indicators, and you can just visually see this, and a bot can see this inside of your automations as well, and I'll show you that. But you can see here that if I was looking at this chart and I was waiting for an opportunity to get into a trade, maybe this is a good opportunity here because the market has started to roll over. We got a nice bullish MACD signal. It was very oversold. And we also had an RSI that was oversold during that time as well. So we had RSI, which was low and coming back up, MACD, which was low and coming back up. Great opportunity. Same thing here. We had RSI and MACD very, very high, markets on a big run. That's a great opportunity to say, hey, I'm going to start curbing some of my bullish positions. Don't get into as many bullish positions or start entering more bearish positions now. Again, great opportunity. Same thing down here at the bottom. You got a nice RSI or MACD buy signal. You got an RSI signal a couple days before then. That was a good opportunity to get into the markets before they made a little bit of a run. Same thing here. We started to see the markets get really, really high on RSI. Just peaked over 70 right there, started to get high. At almost the same time, you got a MACD crossover down as a bear signal. And again, that kind of coincided with the market top, all happening around the same period of time. So it's not that they're all going to line up perfectly on the same day, because they won't. But if you get consensus where you see things really, really overextended or really, really overbought to one side, it might help you lean one way or the other. So right now, things are a little bit more overextended to the downside. Obviously, MACD is super, super low. We don't have that buy signal yet, but RSI is down here. It gives us a little bit of a buy signal because it's really, really oversold. So what that means is that the market right now, as I see it, is a little bit overstretched to the downside. Again, it means that it might favor a little bit of a slowing of this momentum, maybe a reversal, but it definitely doesn't mean that we should fully go into all positions, right? We just start leaning into and tilting into positions, maybe grab a bullish position wait a day or two, grab another bullish position, wait a day or two, grab another bullish position, right? Start building a portfolio of directional trades that way. All right, so now the best thing is, all of this stuff being said, we can actually automate this entire process using bots. So the key here is that now we take everything that we just learned, hopefully, on technical analysis, and we start to incorporate that into bots. Now, the way I think about it is I think about us telling the bot what to do. The bot is a worker for us. And with automations and bots, we basically tell it what to look for and then what actions to perform when it finds those signals. So rather than me sitting in front of my computer every day, because I don't, and waiting for these things to happen and checking 45 different stocks all the time and checking the indicators, it's just very error prone. It's super, super subjective. Even if I get a signal, if I don't get it right away, I might delay getting into it. I might miss an opportunity. I might second guess myself. Bots are not going to do that. They're just going to follow your instructions. Okay. So what we're going to do is we're going to actually go in here and we're going to build a bot that is going to check some of these technical indicators for us. So here I've created just a bot shell. This is just a bot that I've named Combo Technical Analysis Signals Bot. I've connected it to my main TradeStation account. And then so inside of the settings for this bot, what I'm going to do is I'm going to build an automation that basically looks for these technical indicators. So here I'm going to create a new automation. I'm going to call this Combo Technical Signals, and we're going to do RSI plus MACD, okay, for entries. So this is just telling me what this particular automation is going to do. Now, when I start this automation, first thing I'm going to do is I'm going to run through a symbol loop. I'm going to tell it to look for or run through a particular set of symbols. Now, you can connect this to a set of bot symbols that you already have or a watch list. But here I'm going to say things like XSP, XRT, EM, GLD, XBI, TLT. We'll do DIA. We'll do XOP. We'll do XLF, QQQ, some of these other ones, okay? So you can do a big list of these different symbols that you want the bot to loop through. So what it's going to do is it's going to check through all of these different symbols, pull down all the information on these, and now what we're going to have it do is make a decision. Now here is where we go under the folder for indicators, and we have lots of different technical indicators that you can use to incorporate. Now we have some very simple ones where we just use the basic settings for an indicator. So for example, the symbols intraday indicator like RSI is a buy signal. Now, if you want to get really technical, you can say is an exact value, like is 31 or 57.5 or whatever it is, okay? So let's do one of each. So we'll do the RSI as one of the simple recipes. So it's going to already connect your symbol to the ones you're looping through. We're going to choose RSI. Look, you can choose all sorts of these different indicators in here and combine them together. And we're going to say the symbol's RSI reading is a buy signal. So it's not neutral, it's not sell, it's a buy signal. So that'd be generally a reading below 30 for RSI. So that's the first decision that we're going to add here. But what we're going to do is we're also going to add a combo, and we're going to add another decision at the same time. So now what we want to see is we want to see MACD. We're going to use the MACD recipe here. We're going to say the MACD reading. This is your customization of your fast, your slow, your smoothing periods. You can just use the standard defaults here if you want to. That's what I do, okay? The MACD is currently above the signal line. Now this would be your signal line that we showed you in the chart. So that would be your signal line, and it's currently above that signal line intraday. You could also check a day ago, 2 days ago, if you wanted to check historically through things. But this would be an easy one, which would be the MACD line is showing basically a buy signal, and RSI is at the same time also a buy signal. Now, if I put these two together here, then what I get is a combo decision inside of my automation where this has to be true and this has to be true at the same time. This is how you do a combined technical analysis decision where both of these would have to be true at the same time. Now you can do a lot in here. You can do additional decisions or decisions. You can do subgroups of decisions and create different groups and fields. So I'll leave you to doing that, but just right now, this would be a very simple combination decision. And once you add that, then it gets added to your actual automation editor. Now, what I do in this case is I might just rename this and say RSI plus MACD buy signal. And I might do something like this just to streamline my automation, make it easier to read. So do I have an RSI plus a MACD buy signal? If the answer to that question is yes for any of these, so again, we want to make sure that these are true, but if they're true, that would be potentially a buy signal. Then what we might do is we might open a new trade idea that is a bullish position, so a short put spread that's bullish in that symbol, and then you can fill in all of your stuff. Let's say we want to do an expiration that's at least 20 days out, something like this, and you could do optional legs, one contract. You can do some position criteria. This is where, again, where I would layer things on top of this, saying expected value has to be still $5. My probability of profit has to be greater than 60%, right? These are conditions for me of getting into a trade. So even if I have a buy signal, I'm not going to just blindly get into a trade. I'm going to do things like this, right? Maybe expires before the next FOMC meeting. There's no ex-dividends, right? The alpha is greater than, let's say, 5%. I mean, whatever you want to put in here, you put in all of that stuff. Max loss per contract, less than $300. This is basically your shopping list of trade ideas. And so what you're going to do is you're going to say, okay, if I get this signal on any of these indicator or any of these stocks, then get into this trade, get into the best opportunity here ranked by alpha, but it's got to meet all this criteria first. And so then you would go here and save this. And now you have basically an automated way to look for bullish positions when you get that buy signal. Now you can also copy this over, and we're going to copy the action here. And we're just going to copy just this action, and we're going to paste it right here into this step. And we're just going to switch this to the opposite way. And that's going to create a sell signal indicator. So we'll go here. We'll say if RSI is currently a sell, and if MACD is currently below its signal line intraday, both of these have to be true at the same time, then that would give us a potential sell signal. So now we can just rewrite this as sell signal. And if we get a sell signal, then what we want to do is open the opposing type of trade idea. So we would open a new trade that is a short call spread in this case. Again, you could do some of the similar setup or do some things a little bit different. Maybe for a short call spread, maybe your entry criteria is a little bit different. Still want to expire before the next FOMC meeting, no ex-dividend date, risk reward, or let's do alpha is greater than 5%, expected value, let's say is greater than $10 this time, and probability of profit greater than $65. Max loss, you're willing to do $250 on this one. So again, you can just make sure that you put all this stuff in here. This is your shopping list for your trade. It doesn't have to be the same as your put spread opportunity. Again, it's just a custom way to do it, making sure that you get those technical indicators, but also as you're finding a trade idea, that you're only getting into a trade that meets your criteria. And then we simply hit save. So now what we have inside of this automation is a fully automated system which is going to go through these list of stocks right here, right? These potential stocks. It's going to look for a combination buy signal, and then if it has that, open a bullish position. If it doesn't have a combinational buy signal, it's going to look for a combinational sell signal. If it has those, it'll open a bearish position. And if it doesn't have either of those, just do nothing. Just leave this blank. That's okay. Leave the no path blank, which means don't do anything until you have an opportunity to get into a position either way. Now this is really cool because now you have this full system set up. You can also go in here and preset your exits on any of these trades. So let's say you have this one here, which is your bullish position. I can preset my profit taking using exit options to 50% of the credit, or I can remove the position, let's say 3 days before expiration, and I can wait a day to avoid being tagged as a pattern day trader. So now I've set that as my exit criteria. We'll go down here and save. I can do the same thing on the call side. Maybe the call side is a little bit different. Maybe I want to take profits at say 40% and I want to exit this trade, let's say 2 days before expiration. I still want to avoid pattern day trading, so I do that here. Again, this is setting up the entire system to trade automatically for you. Now, once I hit save, this automation is now in here and I have to tell it how often it's going to run. I'm going to run this as a scanner Monday through Friday, all market times. If you wanted to designate certain market times, you could do that here if you wanted to. And then we simply hit save. And now that automation is in place. So what it's going to do is once the automation starts running, it pulls in those lists of symbols, goes through them, checks all the technical indicators, and finds those opportunities to enter or exit positions for you. All right, so let's talk really quick before we wrap up here on automation details here and the benefits and drawbacks for automating this versus manually doing it with technical analysis. As you can see, we went through and just built out a very simple way that you can automate it using technical indicators. There's tons of opportunities to use combo indicators and different indicators at different times. So we'll give you some links to resources below this video where you can check out more of that. But I do want to go through this because I think it's really important just to understand these benefits and drawbacks. The benefits of automation versus manual when it comes to technical analysis, of course, first is no emotion, all discipline. A bot is strictly going to follow your predefined rules, and it's going to eliminate any emotional mistakes. So if you tell your bot, you got to have a buy signal below 30, then it's got to be below 30. It can't be 32, can't be 33. It's got to be that. And what that does, though, is it helps reinforce consistency because the same setup is going to be traded every single time. So later when you start doing your tracking and your analyzing, it's really important to know that you actually consistently made those trades with those indicators. That's really important to know if it's going to work for your strategy. The second thing, of course, is speed and efficiency. So when a technical signal appears, a human, me or you, might hesitate. We might execute the trade a few minutes or hours late. We might just be behind the 8 ball and we start double thinking and second guessing. A bot's going to fire off orders instantly when the moments and conditions are met. That's going to be beneficial for speed and execution. The last thing is multitasking at scale. So I put this one on here because your brain, my brain, is limited in its mental capacity. It just can't handle a certain number of positions as your portfolio starts to grow. It can't remember all of the different ways in which it got into different trades at different times. And so as you start to scale, you need help scanning for new opportunities because you can't physically watch the market all the time. And you need help monitoring those existing positions, maybe even monitoring them to exit using your technical indicators too. Now, of course, the drawbacks, because not everything's sunshine and roses, and of course I want to go through drawbacks. The drawbacks to automation versus manual are few. One is contextual hindsight. So technical analysis indicators have no context of what's going on in the market or the economy or some political news or whatever. So bots don't see the bigger picture like a human does. That's why we always introduced the auto trading platform way back in the day with our first article on automation does not mean unattended. You still want to be attended. You still want to make sure, is this fitting the overall broad picture? My assumption of the economy or markets or whatever the case is, are the bots missing something broadly that I need to adjust an indicator or override a position? You always want to make sure you do that. Too much rigidity. So automated strategies are great because they are consistent, but they have a lot of rigidity, which means if you have very specific tasks, they were definitely going to struggle in adapting to any nuanced condition making. So a lot of times somebody will say, well, the RSI indicator was 31 and the bot didn't fire a position. And I would say, well, of course, because you told the bot below 30 and 31 is not below 30. So that might be a nuanced decision where maybe a human might have made a trade and a bot didn't make a trade. Maybe that was a better trade or not a better trade, but that's the trade-offs that you have to have. Lack of discretion, of course, bots can't execute on or exercise on the spot judgment or gut feelings. They miss subtle cues or unexpected opportunities that a human might spot during black swan events. So again, this is definitely where bots do not do well, is in those subtle nuance things. However, I think broadly speaking, using automated indicators and strategies like this is much better because all of the things you get are all the things we talked about before, which is no emotions and all discipline. It's a much better way of doing it. So personally, I'm okay with all of these. I understand these. I don't let my bots run crazy. I monitor them weekly. I know what they're doing. I see the trades they're getting into, and I adjust on the way if I need to and kind of on the fly, kind of tweaking things or adjusting things. That's the way you should be doing it because there's no way you can 100% foolproof this, but the speed, the efficiency, the discipline, the consistency that you get with automations, to me, is overshadowed for all of the drawbacks and downsides to it. So I really hope you guys enjoyed this video on technical analysis. I hope I covered a lot of the basics for beginners, not only on what technical analysis is, maybe how it's different than chart pattern or chart reading, also some of the very basic technical indicators like simple moving averages, MACDs, RSI. There's lots more that you can explore. We'll give you links below this video for all of those. If you did enjoy this video, please let me know in the comments. Give it a thumbs up, give it a like, share it with your friends, help spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.